Welcome to 3 minutes of adjusting entries. So what you basically need to know in adjusting entries is that it should look something like this, and the rest is understanding and applying the rules and concepts. You adjust a journal entry at the end of the accounting period to record both accrued and deferred revenue and expenses. To recap, when cash is moved before the expense or revenue occurs, it is a deferred expense revenue. When cash is moved after the expense or revenue occurs, it is accrued. So how to perform a deferred versus an accrued revenue adjustment? Remember, when revenue is deferred, a company has been paid before performing the service or before earning their revenue. Because the company has not performed the service yet, the revenue can't actually be recorded. So, the company records the payment as a liability because they owe the service to the other party, the customer. So once the company has completed the owed service, they can now switch the recorded payment from a liability to a revenue. This is the adjusted entry. On the other hand, revenue is accrued when a company performs a service before being paid for it. So to begin with, the company will record the revenue as a receivable, as the money hasn't been received yet. But once the service is complete and the money has been paid, the company will then switch the record from a receivable to a revenue. This is the adjusted entry. Now, how to perform a deferred versus an accrued expense adjustment. A deferred expense is when a bill is paid in advance, such as when rent is paid at the beginning of the month before the actual rent period has occurred. This means that the expense paid for, whether it be rent, broadband, a Spotify subscription, becomes your asset. You have paid for it, you are entitled to it, you are owed it. And it is written like this. However, once the business has used up its month of rent, its 1,000 gigabytes of internet, its year of Spotify use, it no longer is in possession of the asset. So that asset account is deducted from, and the value deducted becomes an expense. Another type of deferred expense is value depreciation, which follows the same concept. When a company pays for an expense after it has used a service or product, if a company pays for its rent, broadband, Spotify at the end of the month, it is an accrued expense and it is a liability. When the expense has been paid for, the amount is switched from an expense to an account payable. Thank you.